I think what's going to happen is the fundamentals in play and the macro technicals, in fact, argue that this bull trend in monetary metals is likely going to end up with them becoming institutionalized. This government, that government, finally more and more saying, hey, this fiat currency game, unbacked currency game hasn't really been working. It's ultimately been a negative. It creates boom bust cycles. Let's just go back to, gold or silver as monetary metal. And I think at some price level, I don't know, gold may be 10,000, 20,000, I have no idea, but some level, when enough of these dynamics.
The facade of market strength is fading fast, with informed investors already repositioning ahead of a structural reckoning. Prominent technical analyst MichaelOliver brings decades of market expertise to the evolving dynamics of gold and silver. In this video, Oliver anticipates a major breakout in monetary metals by year-end, led by silver. He views past peaks as misleading and believes silver's true inflation-adjusted value exceeds $200. This move reflects deep structural cracks in equity markets nearing a breakdown. Historically, silver prices have exhibited significant volatility, characterized by notable peaks and troughs. For instance, silver reached a record high in 2011, driven by robust investment demand and industrial usage. Silver's historical performance indicates a potential for high returns and significant fluctuations, which should be a key consideration for investors. In his outlook, Oliver emphasizes that gold has consistently outperformed the S&P 500 over the past 25 years, a fact largely overlooked by mainstream financial media. Drawing on historical precedent, he suggests that gold could surge to $8,000 or higher, particularly as investors seek refuge from deteriorating risk assets and as central banks pivot back to monetary easing and aggressive rate cuts. He cautions that in a full-blown market breakdown, gold and silver will emerge as the primary safe haven assets. However, if the Federal Reserve were to drastically cut interest rates as the Trump administration desires, leading to a sharp devaluation of the dollar, the stock market rally might face negative reactions. This happened in October 1987. Technical analysis reveals compelling evidence for gold's continued defensive strength. Current chart patterns display a series of bull flags consolidation periods following strong upward moves that typically resolve with further upside. In the long run, MichaelOliver expects gold and silver to be remonetized as trust in fiat collapses. Before we dive into MichaelOliver's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I think between now and the year end, we're going to have an enormous up move in the monetary metals, led by silver, led by the gold and silver miners. Gold, strong as well, but not on the percent basis as those subsets. And I think at the same time, we're going to see the stock market finally demonstrate to people that what's been going on since late 2024 is we don't trust the new stock market high that was made by a narrow select group of indexes and a few sectors. And we think once it rolls over again, enough to convince the price guys. Momentum's already convinced. It's no good. Okay. Price is the one that people look at. And when you roll over enough, like get back below those highs we saw in January, and people start scratching their heads saying, well, I thought. And suddenly some of them realize more and more that hey, something's going on here. Somebody's dumping it into the stock market since late 2024, and it's not going anywhere. And meanwhile, gold has been advancing solidly since then, and et cetera, et cetera. Anyway, that's, I think, watch those two categories because if the stock market does roll over more, that's going to help fuel gold even more so. And also we know it's going to spark the central banks into doing that which they do best, which is to, further help destroy the money unit by quantifying it more and cutting interest rates as well as the president has demanded. But if you go back and look on a logarithmic scale chart to when gold was legalized by our government in 1975, there have been two massive bull markets that were eightfold gains, bear low to bull high. Well, if we had an eightfold gain, our bear low was $1,050. That means $8,400 to have an eightfold move. And all you're doing then is replicating what you've already done twice in the last 50 years under conditions that aren't nearly as dramatic as the conditions that are building now in global markets and in the implosion of the U.S. bubble market, stock market. Once that starts to get unfold more clearly to the average investor, that's when gold goes berserk. It's been behaving as a great alternative to the stock market already, going back a year, 3 years, 5 years, 10 years. and certainly 25 years. And yet that's not a headline story on Fox Business News or CNBC. Instead, they're focused on what's NVIDIA doing, et cetera. So there's really no resistance on silver at this point going forward, other than what I call the idiot highs that occurred at 50 back in 1980 and 50 again in 2011, early 2011. But those highs, remember, decades ago. And if you factor in the decay in the money unit, which is to say it increases in supply about 90% every decade. Okay. So it's the real buying power. If you took silver to a price level that matched those highs in terms of real dollar value, silver would probably be $200. Okay. Now I'm not predicting a high. I did have predicted, however, that in this thrust that we're in now, that commenced in June, actually, when it came up to 34 again, and then finally blew through the price highs at 35. There were two highs there, October last year and March of this year. And then you got up to 39, and right now we're 37.5 zone. This move should take you probably to over 50. I'm guessing between 60 and 70, not just a wild guess, by the way, between now and year end. In other words, take out those old idiot highs that everybody seems to think are meaningful. Buy enough to where everybody says, well, golly, we're in never land here. Where are we going? And suddenly you wake up the population, the investor population, to a market that's already been doing quite well for the last, decade plus. And if you look at a monthly close only chart of silver net price, just the monthly closes, forgetting, and go back to 1980, for example, if you can go back that far. The highest monthly close back then was $34.50. It traded up to 50, but that was phantom. The highest monthly close was $34.50. Yeah, you see it there.
Yep.
And just short of 50 back in the 2011 peak. So those highs were really phantom. In other words, you didn't even stay up there very long. It was gaseous. And so when you made the high, you collapsed. You didn't fool around. The next month after the new high, wham, they got hit. Those highs are coming out, and I don't think we'll pause until we're credibly beyond those. And I suspect that'll be by the end of this year. And that's just this thrust. I'm not talking about the end of the bull market. In fact, my view of the end of the bull market is there won't be an end as such. I think what's going to happen is the fundamentals in play and the macro technicals, in fact, argue that this bull trend in monetary metals is likely going to end up with them becoming institutionalized. In other words, this government, that government, finally more and more saying, hey, this fiat currency game, unbacked currency game hasn't really been working. It's ultimately been a negative. It creates boom bust cycles. Let's just go back to, gold or silver as monetary metal. And I think at some price level, I don't know, gold may be 10,000, 20,000, I have no idea, but some level, when enough of these dynamics come into play, and I don't mean the gold price dynamics, but I'm talking about world economic situation, turmoil, a sense of uncertainty on the part of public, a sense of panic on the part of the public. And it doesn't take much to get you there, and inflict pain on the public, in other words, to where they say, we need something different. And I think we're going to have monetary metals institutionalized once again after this next crisis, which is yet to unfold in the eyes of most people.
In this unfolding environment, MichaelOliver warns that recent dollar strength is deceptive, masking a deeper momentum breakdown. According to him, gold has gained 3 times while the dollar index still sits near its 2015 level. He emphasizes that long-term momentum indicators point to a decisive structural breakdown in the dollar. Morgan Stanley's US dollar forecast is actually showing some pretty concerning signs for 2025 and beyond, with analysts predicting the greenback could lose up to 9% of its value over the next 12 months. The US dollar's 2025 outlook has become increasingly complicated due to President Trump's trade policies. The currency has already taken a significant hit, dropping nearly 10% since the beginning of February. This 2025 US dollar outlook suggests that more volatility is on the way. MichaelOliver maintains his January S&P sell call, citing long-term momentum breakdowns echoing past crises. He highlights the narrow nature of recent market highs and contrasts it with gold's strong performance. Let's get back to the interview.
If you go back 10 years, the dollar right now is trading where it was in December of 2015. It's been above it and below it. Well, gold has tripled since December of 2015. Okay. And the dollar index right now is trading, if you drew a line horizontal back to the close of 2015, it's the 98 level. And where you're trading at 98 on the dollar index.
Right.
So anyway, it's absurd. So, but the dollar index has, right now, you've got a price trend line there that's being challenged. But annual momentum has blown that structure. Prices usually lag to momentum. So the buying you've seen lately in the dollar is price chartists buying a simplistic uptrend. The problem is when you run 3-year average momentum and 10-year average momentum, any uptrend you could plot going back more than a decade, totally broken. So the dollar index, as far as we're concerned, is now a negative major global factor. For several years there, it was neutral. It was up and down on an 8% range, 2023 and 24. It was going nowhere. So it didn't influence anything. But now it's started to break. And probably once you go down and make yet a new low and break this price chart, then the price chart folks are going to realize, oh, golly, the dollar's in play to the downside. All the rallies were futile. Momentum says expect that. And so suddenly you've got another major asset factor that's banging into other assets, causing asset class flow out of certain areas into others. You know, if you're a foreign investor in the U.S. stock market, you care about what happens to the dollar because you own stocks in dollars. Okay, so if the dollar breaks 10%, you know, that adds to any breakage the S&P might have for you, you know, European or whatever. Anyway, that's another asset to watch. In January, we put out a sell recommendation on the S&P based on long-term momentum trend breakage, meaning be gone. Leave it as an investment asset. Go away. And we had a sharp drop into April. Problem was it was news related, and those are the worst kind of drops because you quite often you want a drop that nobody can quite figure out why. Okay, that's the best kind. But anyway, so we had a news related, and we predicted, where you've got a circle there, in fact, on that chart, we predicted there would be a bounce point there at 4,800, well before it ever got down there. And sure enough, they bounced at 4,835 and continued to bounce and went up and made a new high, new marginal high. We're talking several percentage points above the high we saw in January, that first upper circle. Okay. Now, this process where momentum breaks something serious and long-term occurred in 2000, in January of 2000 at the dot-com top. We had a drop into February, but then in March of 2000, it went back up and made a new high. So a lot of our subscribers said, oh, boy, you were wrong. And well, it didn't go anywhere. It made a new high and just sort of squatted. Wasted the year 2000, up and down, either side of our be gone signal. Finally, in 2001, it started to fall apart. And you never crashed or anything like that. You just had a bloody decline, 50% S&P. And for the NASDAQ 100, an 82% drop, wipeout. Okay. 2007 was a similar arduous top where, you know, when you made your high, it didn't just make a high and collapse or anything like that. It made a high, went down, made a marginal new high with a Fed rate cut, by the way. And, you know, that circle there is about a year of twisting and turning with action marginally above the 2000 high. So if you're a price guy and you drew a line across the 2000 high, in October of 2007, you said, oh, wow, a major breakout. Okay, well, it was baloney, okay, because long-term momentum had already said no good. Finally, it started to come apart. Okay, took it a while. We've got the similar type of arduous year-wide type pattern now where we had distribution, some buddies said in 2024, the latter part of that year, and into early 2025, I went out, and therefore you plateaued for quite a few months, had your drop into April, then came up and you've now made a, quote, new high. Now, by the way, when you really examine, quote, the market, not just S&P or NASDAQ 100, there's quite a few sectors, quite a few symbols, including most of the Mag 7, are not making new highs. Microsoft and NVIDIA have,
right,
and Meta, but the other 7, they're not making new highs. Yeah, it's now the Mag 3 or Mag 2. Okay. So just as the Magnificent 7 has dwindled in terms of leadership, so has the market itself. When you examine certain sectors, you'll see, hey, they're not making new highs. You know, what's going on here? I hear this new high stuff. It's very limited, very narrow. Okay. What happened last week on the close was sufficient weakness on the part of the S&P and the NASDAQ and a lot of other sectors within the market to indicate to us that there's a good chance the high you just saw prior week was it. And probably you're going to start now to sink back down. See, you're rallying today up into that gap you left on Friday. But if that high basically was it, and you did enough damage into the end of the week to indicate to us that this, quote, new high is in question. And once you get price action back below the price highs we saw in January, which is in the 6,100 zone, okay? Then suddenly the guys who think this price breakout was valid will say, hey, how come we're back below the old high? So that's what we're looking for right now. But it's interesting to note that, there's a widespread assumption that if the stock market goes down hard, gold will go down hard too, right? Everybody says that. Well, look at January through April on S&P, and then look at January through April on gold. Total opposites. Gold went vertical, stock market went down.
Beneath the market's glossy surface, cracks are widening, and the smart money is slipping out quietly before the storm hits. Historically, when economic conditions are unfavorable, certain assets are expected to perform better. We're going to take a closer look at this, focusing on gold and silver, which often come up in conversation as safe bets. While silver tends to be more volatile than gold due to its smaller market size and fluctuating industrial demand, this volatility can create opportunities for strategic buying during price dips and selling during surges. As momentum shifts and systemic cracks deepen, will you remain anchored to legacy assets or pivot toward the monetary metals before the real breakout begins? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.